welcome to another episode of Economic Insights. I'm your host, Alex, and as always, I'm joined by market veteran and our show's producer, Selim. Selim, what a week. Where do we even start?
Alex, this was a week where the market couldn't make up its mind. We started with a rally, got punched in the face by a jobs report, then got a hug from inflation data. It was like an emotional roller coaster.
Ha! Let's walk through it. The week started pretty positively, right?
It did. Two big stories early on. First, Japan. Prime Minister Takechi won a landslide in the general election, securing a supermajority with 316 seats for the LDP. Japanese equities surged to record highs, and the yen firmed up a bit. Second, in the US and Europe, we got a relief rally after that volatile period driven by AI fears. The S&P 500 and STOXX 600 were approaching or hitting record highs. UK was the odd one out, underperforming on political uncertainty around PM Starmer, though gilt yields stabilized after his cabinet publicly backed him.
But then things got messy midweek.
Very. We got a series of conflicting signals. First, weak US data, flat retail sales, and the softest employment cost index since 2021, which rose only 0.7% quarter on quarter. Markets went risk off, Treasury yields dropped, and traders started pricing aggressive Fed cuts. Then, boom, the delayed January jobs report came in much stronger than expected. Non-farm payrolls jumped 130,000, well above consensus of 65,000. Private payrolls rose 172,000, and the unemployment rate dropped to 4.3%. All those rate cut bets got unwound in a hurry,
That's quite a whiplash. And then we got the inflation print.
right? The CPI came in and gave the bond market a bit of relief. Headline CPI rose just 0.17% month over month, softer than expected, with gasoline prices doing a lot of the heavy lifting on the downside. Core was 0.30%. Year over year headline fell to about 2.4%, core to 2.5%. Some analysts called it a Goldilocks scenario, strong jobs but tame inflation. Treasury yields fell back to their lowest levels in years.
So everyone relaxed?
Not quite. Equities stayed capped because tech megacaps were under serious pressure all week. AI disruption fears shifted from being a growth story to threatening asset light industries like software and finance. And here's something worth flagging. Many of Wall Street's high conviction consensus trades from the start of the year have basically collapsed. Crowded positioning and record low cash levels created a web of leverage where selling in one sector forces liquidations in others. Investors are fleeing to previously unfavored safe havens like treasuries, and there are real concerns that losses in the software sector could spark broader contagion.
That's a worrying dynamic. And gold had some drama too?
Gold had what some are calling a shock sell off. Algorithmic trading drove a sharp drop before it recovered back above $5,000. Oil was volatile all week on headlines about potential US Iran negotiations. And European leaders gathered for a summit to discuss competitiveness, reviewing Mario Draghi's recommendations, though implementation of those has been painfully slow. Only about 15% of his 383 recommendations fully enacted so far.
Let's dig into developed markets. Starting with the US, the Fed must be watching all of this closely.
The Fed is in a holding pattern, Alex. The combination of a solid jobs report and sticky inflation makes it very hard for them to cut. Let me break it down. On the jobs side, yes, 130,000 headline was strong, but there's nuance. Healthcare and social assistance added about 124,000 of those jobs. Strip that out, and private employment growth was only around 49,000. Plus, the benchmark revision lowered estimated employment for March 2025 by 862,000, meaning 2025 job growth was actually much slower than originally reported.
That's a massive revision.
It is. And on inflation, while the CPI print looked benign, don't be fooled. Core PCE, which is the Fed's preferred metric, is tracking somewhere between 0.32% and 0.36% for January. That's because PCE puts less weight on used vehicles, which dragged CPI down, and more weight on things like legal services where prices jumped. The inflation outlook remains sticky rather than solved. Services inflation is expected to drift sideways around 3%, and tariff pass-through is keeping goods inflation elevated. The market is now looking at potentially June or even December for the next Fed cut.
And there's the Kevin Warsh nomination as Fed chair to watch too.
Correct. There's been discussion about shrinking the Fed's balance sheet, but analysts note significant constraints. The balance sheet size is really dictated by liabilities like currency in circulation and the Treasury general account. You'd need regulatory changes to reduce bank demand for reserves without causing funding market stress. It's not as simple as the new leadership might hope.
What about housing?
Existing home sales fell 8.4% in January to 3.91 million annualized, the lowest since September 2024. Affordability is the killer. High prices and mortgage rates around 6.2%. The administration tried directing government sponsored enterprises to buy mortgage backed securities to lower rates, but the impact is expected to be minimal. The real problem is structural, zoning regulations limiting supply. And that's a local issue, not federal.
Let's cross the Atlantic. Europe?
Eurozone Q4 GDP was confirmed at 0.3% quarter on quarter, which sounds okay, but underlying momentum has softened entering 2026. December industrial production is expected to show a decline of about 1.5%. The bright spot is Germany, interestingly enough. Manufacturing orders surged nearly 10% quarter on quarter in Q4, reaching levels not seen since mid 2022. But here's the twist: it was driven largely by defense spending. Domestic orders for weapons and ammunition shot up well above historical averages.
Germany finding growth through defense spending. That's quite a change.
It is. But production only rose 1% despite those orders because they're constrained by labor shortages, not material shortages. 16% of companies report a lack of skilled workers. On the inflation front, risks are tilted to the downside for the Eurozone in 2026. Core inflation is projected to fall below 2% from quarter 4 2026. Negotiated wage growth is decelerating. France had some news too. The Banque de France governor announced he'll resign in June, ahead of his term's end.
And the UK politics were front and center this week.
Yes, and the UK economic growth basically stalled. Q4 GDP growth came in at just 0.1% quarter on quarter, missing expectations. Government investment surged 11.6%, strongest since the pandemic, but private sector demand was weak. For the full year 2025, GDP expanded 1.3%, which beat expectations set at the start of the year. But the momentum is fading. The case for a Bank of England rate cut in March is building. Stagnating employment, slowing inflation. Headline CPI is expected to drop to around 3.0% in the upcoming data.
And Japan. We mentioned the election. What does that mean for markets?
The supermajority gives Takaichi enormous political capital. The policy agenda is what they're calling Sanaenomics, responsibly proactive fiscal policy, a temporary consumption tax exemption on food, accelerated corporate reform. The interesting bit is how they plan to fund it. They're trying to avoid new deficit covering bonds, looking at non tax revenues like returns from FX reserves. Markets are optimistic. Nikkei targets are being revised above 60,000 by year end. The Bank of Japan is expected to continue normalizing with a potential rate hike as early as April and a terminal rate projected between 1.5% and 2%. Q4 GDP is expected at a solid 1.2% annualized.
Let's move to FX and commodities. The dollar story is interesting.
Multiple sources maintain a bearish stance on the dollar, Alex. The thesis is that the US is losing its exceptionalism across yield, growth, and safe haven dimensions. The stock market is now seen as risky because of AI concentration risks, and there's a decoupling happening. The dollar has weakened even as US equities underperformed, which is unusual. Capital is rotating toward rest of world assets. Eurodollar is being targeted at 1.20 by some analysts, driven more by asymmetric US outcomes than pure Eurozone strength.
The yen was interesting after the election.
Counterintuitive, actually. You'd think a landslide promising fiscal expansion would weaken the yen. Instead, it initially strengthened on broad dollar weakness and unwinding of short positions. But medium term, the view remains bearish for the yen. Monetary policy behind the curve, expansionary fiscal policy. Intervention risks are real if dollar yen pushes past 160. The Swiss franc is also interesting. Asset managers are hedging their dollar exposure at the fastest pace in a decade, driving structural flows into the franc.
Gold at $5,000. And what happened in that flash crash?
Open interest on COMEX has fallen to a 2 year low. Gold had that algorithmic driven shock sell off but recovered. There's an interesting dynamic in China. A gold premium has emerged in Shanghai alongside a strengthening yuan, which suggests the government has less incentive to restrict import quotas. That could support gold. Silver had some supply signals too. Backwardation appeared in prompt contracts, indicating excess demand for immediate delivery. Chinese silver ETF premiums hit record highs.
Copper?
Copper prices have held up despite weakening fundamentals. Chinese demand contracted 8.4% year on year in December. Apparent demand fell 12%. Global visible inventory has exceeded 1 million tons. China's been exporting refined copper, up 74% year on year, while the US has been importing heavily, likely front running potential tariffs.
Let's head to emerging markets. India first?
India rolled out a new CPI series with a 2024 base year, which is significant because the weight of food in the basket dropped about 9 percentage points to roughly 37%. January headline inflation came in at 2.8%, up from about 1.1% in December, mainly on less favorable base effects and food. The budget targets a fiscal deficit of 4.3% of GDP. The story here is a country doing fiscal consolidation while still growing, quite a feat.
Turkey?
The central bank revised its year end inflation forecast upward. The midpoint is now 18%, up from 16%. The 27% minimum wage hike didn't help, but the base case remains for a 100 basis point rate cut in March. The economy is expected to grow around 3.5%, a soft landing. Foreign inflows into local debt have accelerated significantly in early 2026. Equities are trading near historic lows relative to EM peers, which has some analysts overweight. And there's a geopolitical angle. Turkey is viewed as uniquely positioned for reconstruction in Syria, Ukraine, and Gaza, which could benefit cement, industrial, and energy sectors.
South Africa?
Interesting story there. Foreign investors have returned in force, the strongest start to the year for foreign inflows in over a decade. January saw 34 billion rand added to local bonds. South Africa is experiencing a commodity windfall driven by gold and platinum prices. There's a two-track mining sector, though. Precious metals are capitalizing on the price surge, but bulk commodities like coal and iron ore are still hampered by rail and port inefficiencies. Currency models suggest potential strengthening toward the 13.85 to 15.30 range against the dollar.
China?
Deflation continues to haunt China. CPI slowed to 0.2% year over year. PPI deflation narrowed to minus 1.4%, but consumer demand remains soft. Housing sector still struggling, though the decline in secondary home prices narrowed slightly. Credit creation was weak. The growth target for 2026 is expected at 4.5% to 5.0%. FX reserves rose in January, suggesting strong exports from front-loading ahead of Lunar New Year. The yuan is being managed toward gradual appreciation. Forecasts have it at 6.7 per dollar by year-end.
Any other EM highlights?
Hungary is one to watch. The April parliamentary election is shaping up as a binary event. Independent polls show the Tisza party leading Orban's Fidesz by 8 to 12 points. Markets are heavily long the forint, betting on regime change that could unlock frozen EU funds. A decisive Tisza victory strengthens the currency. A Fidesz win could trigger a sharp reversal. South Korea raised GDP forecasts to 2.3% on the AI chip boom. Exports surged in January, and they have an unconventional growth driver. BTS is back, and searches for Seoul travel have jumped.
BTS is a macro indicator. I love it. What should we watch next week?
It's a packed calendar. US markets are closed Monday for President's Day. Japan releases Q4 GDP on Monday. Tuesday brings UK labour market data and Canadian CPI. Wednesday is the big one. FOMC minutes from the January meeting, plus UK CPI and the RBNZ rate decision. Thursday has US jobless claims and the Philly Fed survey. Friday is absolutely stacked. US PCE inflation, preliminary Q4 GDP, and flash PMI figures for the US, UK, Eurozone, Germany, France, and Japan. Japan also releases national CPI on Friday. On the corporate side, Walmart reports a key reading on the consumer, plus Deere, Airbus, Nestle, and all the major miners BHP, Glencore, Rio Tinto, Anglo American.
That's a monster week. Anything in particular you'll be focused on?
The PCE print is the one. Core PCE is expected at plus 0.4% month over month. If that comes in hot, any remaining hopes for near term Fed cuts evaporate. And the FOMC minutes should give us a window into how divided the committee really is.
Salem, thank you as always. Brilliant stuff. And folks, don't forget, we do not give investment advice. For that, please consult a professional. See you next week.